Welcome to This Explainer. Today, we're jumping right into a fascinating case study on steel dynamics. This is a company that literally took the idea of a circular supply chain and flipped it on its head. It's no longer just some feel-good environmental initiative for them. It is a hardcore, incredibly profitable business strategy. We're going to break down exactly how their unique circular engine fueled some massive financial triumphs in 2025 and why it's fundamentally shaking up the entire landscape of global manufacturing.
Okay, let's dive right into this. Just look at the sheer scale we're talking about here. In 2025, Steel Dynamics hit a staggering record, shipping 13.7 million tons of steel. And that massive volume, it translated directly into $18.2 billion in net sales. We aren't talking about small incremental improvements here. These are monumental, game-changing milestones. It's really a testament to a hyper-efficient operating model that let them capture market share and maximize output even when the broader global economy was, well, more than a little complicated. So, here's our quick roadmap for today. First, we'll look at those record-breaking 2025 results. Then, we'll unpack their circular manufacturing engine. After that, we'll dive into their electric arc furnaces and OmniSource integration, followed by their bold aluminum expansion strategy. Finally, we'll wrap up with their vision for sustainable strategic growth.
Starting off with Section 1, record-breaking 2025 results. Let's see how they pulled this off.
Seriously, how did Steel Dynamics manage to outpace the broader market so significantly? Well, it all anchors back to this massive number, $18.2 billion. I really want to emphasize the scale of that achievement because, you see, this wasn't just a lucky year and it wasn't a temporary bump in commodity pricing. This top-line revenue is the direct result of a highly variable cost structure. Compared to traditional integrated steel producers, their low-cost position is a huge advantage. When market demand swings up and down, their flexible structure lets them pivot on a dime, protecting their margins while still driving that massive revenue.
And when you peel back the layers on that revenue, the underlying profitability is just wow. We're talking $1.5 billion in operating income and $1.2 billion in net income. Plus, they generated a massive $1.4 billion in cash flow from operations. But what's truly remarkable is what all this cash actually allowed them to do. They literally funded their massive growth projects entirely from cash on hand. And after all that, they still had enough left over to buy back over 4% of their outstanding shares. That's roughly $901 million worth, all while sitting on over $2.2 billion in liquidity. I mean, that is the very definition of a fortress balance sheet.
Let's move on to Section 2, the circular manufacturing engine.
Now, what's really interesting about this slide is that it shows us the why behind those massive numbers. This right here is the secret sauce, a closed-loop circular manufacturing model. Essentially, scrap metal from manufacturing and end-of-life items gets collected, processed, and then fed right back into production as their primary raw material. For Steel Dynamics, decarbonization isn't some pesky regulatory burden dragging down their bottom line. Actually, it's the exact opposite. It's a structural cost advantage. By running this model, they actively steepen the global cost curve heavily in their favor. It's basically a massive strategic moat, perfectly disguised as a green initiative.
Let's walk through how this seamless flywheel actually works in practice. Step 1, collect. Their massive metals recycling platform, OmniSource, goes out and gathers scrap from end-of-life stuff. Think old cars, broken appliances, you name it. Step 2, process. They sort and refine all that raw material. Step 3, recycle. That processed scrap gets fed directly into their own mills. And finally, Step 4, manufacture. They turn it into high-quality, value-added products to sell to consumers. And guess what? When those products eventually reach the end of their useful lives, the whole cycle just starts right back up again. It is a completely, infinitely self-feeding engine.
All right, on to Section 3, EAFs and OmniSource integration. Let's see how this creates an operational edge that leaves everyone else in the dust.
Just take a look at the stark difference in these utilization rates. While the rest of the domestic steel industry was chugging along at an estimated 77%, Steel Dynamics had their mills running at a scorching 89%. So, how are they running so much hotter than the competition? It really boils down to three things: their value-added product diversification, their highly customized supply chain solutions, and the relentless support of their own internal manufacturing businesses. Because their internal supply chain is so tight, their furnaces are literally never starved for material. Plus, their downstream fabrication arms ensure there's always a steady, hungry market for whatever they output.
But to keep mills running at an 89% utilization rate, you need a staggering amount of raw materials. Dry 41 million tons.
That is the sheer volume of ferrous scrap that Steel Dynamics pumped back into the manufacturing life cycle between 2023 and 2025. Since their steel operations rely exclusively on electric arc furnace or EAF technology, recycled ferrous scrap is hands down their biggest raw material input. In fact, in 2025, their EAF mills were churning out steel made with an average of 88% recycled content.
And the scale doesn't stop with steel. Check out this figure. 2.9 billion pounds. That's the mountain of non-ferrous scrap they reintroduced into the life cycle during that exact same 3-year window. You know, OmniSource is actually the largest non-ferrous metals recycler in all of North America. Processing this incredible volume of non-ferrous material didn't just boost their current bottom line, it perfectly set the stage for their next big, highly lucrative move.
Which brings us to Section 4, the aluminum expansion strategy.
So Steel Dynamics is taking this proven, incredibly profitable circular playbook and they're bringing it to a brand new vehicle. It's a brilliant illustration of their overarching strategy. CEO Mark Millett pointed out something wild. A new aluminum flat-rolled mill hasn't been built in North America for over 40 years. 40 years. So Steel Dynamics isn't just dipping their toes into a new market, they are straight up copying and pasting their winning steel formula, that lean, hyper-efficient mini-mill culture, directly into a severely underserved aluminum market. It's a real game changer.
Let's break down the financials for this massive new venture. The Columbus Mill and its satellite slab centers represent a whopping $2.7 billion investment. It's designed to pump out 650,000 tons of capacity. But look at the expected return. We are talking a projected annual EBITDA between $650 and $700 million through the cycle, plus another $40 to $50 million just from the recycling side. And honestly, the most impressive part? They completed this massive, state-of-the-art expansion near budget and funded the whole shebang entirely through existing cash flow. Zero sacrifice to their investment-grade credit profile. There is no way many companies could pull that off.
Now, if you're wondering, does the market actually want all this new capacity? Consider this mind-blowing fact. Product certifications for automotive sheet usually take months, sometimes over a year of back-and-forth testing, but a Big 3 automaker just approved trial material from Steel Dynamics' new aluminum lines for actual production in less than 5 weeks. 5 weeks! That just proves there is an immediate, intense hunger in the market for high-quality, domestically sourced, low-carbon aluminum. The customers aren't just ready for it, they are practically begging for it.
Finally, Section 5, Sustainable Strategic Growth.
It is definitely time to reframe what sustainability actually means for a true manufacturing powerhouse today. The big takeaway here is this. Moving into aluminum acts as a massive hedge against customers swapping out carbon steel for lighter materials. It diversifies their entire portfolio into counter-cyclical markets, like sustainable beverage packaging, which beautifully stabilizes their cash flow. They're combining incredible labor efficiency with sky-high yields. Ultimately, Steel Dynamics is using these environmental initiatives as a weapon to capture market share. They've successfully taken lower carbon manufacturing and forged it into a long-term, highly profitable competitive moat.
Which leaves us with this final, provocative thought to chew on. As decarbonization continues to materially steepen the global cost curve, will this closed-loop, circular model stop being just a cool competitive advantage and instead become the absolute standard for survival and profitability in global manufacturing? Looking at Steel Dynamics' 2025 results, they make a pretty compelling case that the future isn't just coming, it's already here. Thank you so much for joining me for this explainer, and I'll catch you next time.